Okay, so welcome back to today's webinar, guys. And we are currently in chapter 3 of Introduction to the Stock Market. And this time around, we'll be moving a bit deeper as we talk about what moves the stock market, how does the stock get traded, and how to calculate your returns and where to fit in. Uh, so join us as we get a wonderful overview of how to know what moves the market. Next page. Now, when we talk about the overview about these things, having understood what IPO process and what really goes behind the company's transition from primary to secondary market, we are now set to explore the stock markets a step further. By virtue of being a public company, the company is now liable to disclose all information related to the company to the public, and the shares of a publicly limited company are traded on the stock exchanges on a daily basis. There are few reasons why market participants trade stocks, and we'll explore these three reasons in this chapter. Number one, next page, is trades that are per point of view, and like we discussed, the stock market is an electronic marketplace. Buyers and sellers meet and trade their point of view. And for example, we consider the current situation of Infosystems at the time of writing this. Infosystem is facing a succession issue, and most of its senior level management personnel are quitting the company for internal reasons. And it seems like the leadership vacuum is weighing down the company's reputation heavily. So as a result, the stock price dropped to 3,000 rands and all the way from 3,500 rands. And whenever there are new reports regarding Infosystem management, the stock prices react to it and assume there are two traders, T1 and T2. Now, the point of view of Infosystem, the stock price is likely to go down further because the company will find it challenging to find a new CEO. If T1 trades as per his point of view, he should be a seller of the Infosystem stock. Now, however, views the same situation in a different light, and therefore there's a different point of view. And according to him, the stock price of Infosystem has overreacted the succession issue, and soon the company will find a great leader, and after whose appointment the stock price will move upwards. Now, if T2 trades apart his point of view, he should be a buyer of the Infosystem stock. So as R3 1000, T1 will be a seller and T2 will be a buyer in Infosystems. Now, both T1 and T2 will place orders to sell and buy the stocks respectively through their respective stockbrokers, and the stockbroker obviously routes it to the stock exchanges. Next page. The stock exchange has to ensure that these two orders are matched and the trade gets executed. So this is the primary job of the stock market, to create a marketplace for the buyer and the sellers. And of course, the stock market is what we know as a place where market participants can access any publicly listed company and trade from their point of view, as long as there are other participants who have an opposing point of view. And after all, different opinions are what makes the market move. Next page. Now, primarily, what moves the stock market? For example, let it be around 10 a.m. on 11 June 2014, and the price of Infosystem is 3,000. The management makes a statement to the press that they have managed to find a new CEO who is expected to steer from company to greater heights. They are confident on his capabilities, and they are sure that the new CEO will deliver much more than what is expected out of him. Two questions in mind would be, how will the stock price of Infosystem react to this news? And two would be, if you were to place a trade on InfoSystem, what would be? Would it be a buy or a sell? The answer to the first question is quite too simple. The stock price will move up. InfoSystem had a leadership issue and the company had fixed it. When positive announcements are made, market participants tend to buy the stock and at given price, and this cascades into a stock price rally. Let me illustrate this further. In this table, we are seeing a table of time last traded price, what price the seller wants, what does the buyer do. Well, expecting this to be, we are seeing 1, 2, 3, 4, 10, 3,000, 3002. He buys in 3002. The same thing applies for this. At 10 a.m., last traded price was 3002. The price the seller wants is 3006. And what does the buyer do? He buys, and the new last price was 3006. Then at 10:03, last traded price was 3006. What price the seller wants was 3011. He bought, and the new last traded price was 3011. And at 10:05, the last traded price was 3011. The prior price the seller wants was 3016. He bought, and new last traded price was 3016. Next page, please. Now notice that whatever prices the seller wants, the buyer is willing to pay for it. This buy-seller reaction tends to push the share price a bit higher. So as you can see, the stock price jumps 16 rupees in a matter of 5 minutes. And though this is a fictional situation, this is very realistic and typical behavior of stocks. The stock price tends to go up when the news is good or expected to be good. And in this particular place, the stock moved up because of two reasons. One, the leadership issue had been fixed. And two, there's also an expectation that the new CEO will steer the company to greater heights. So the answer to the second question is now quite simple. You buy InfoSystem stocks considering the fact that there is good news surrounding the stock. And now moving forward in the same day at 12:30 p.m., the National Association of Software and Self-Loss Company, popularity abbreviated as NASCOM, makes a statement for those who are not aware. NASCOM is a trade association of Indian IT companies. NASCOM is considered to be a very powerful organization, and whatever they say has an impact on the IT industry. NASCOM makes a statement stating that the customer's IT budget seems to have come down by 15%, and this could have an impact on the industry going forward. By 12:30 p.m., let us assume InfoSystem is trading at 3:30. Few questions for you. First will be, how does the new information impact InfoSystem? B will be, if you were to initiate trade with this information, what would it be? And C will be, what will happen to the other IT stocks in the market? Next page. Answers to the above questions are quite simple. Before we start answering these questions, let us analyze NASCOM's statement in a bit more detail. NASCOM says that the customer's IT budget is likely to shrink by 15%, and this means the revenues and the profits of IT companies are most likely to go down soon. This is not great news for the IT industry, but let us now try and answer the above questions. First, will InfoSystem, being a leading IT major in the country, will react to their news. The reaction could be mixed on one because earlier during the day there was a good news specific to InfoSystems, and however, a 15% decline in revenue is a serious matter, and hence InfoSystem stocks are likely to trade lower. At 30:30, if one were to initiate a new trade based on the new information, it would be a sell on InfoSystem. The information released by NASCOM is applicable to the entire IT stocks and not just InfoSystem. Hence, all IT companies are likely to witness a selling pressure. So as you notice, market participants react to news and events, and their reaction translates to price movement. This is what makes the stock markets move, of course. Now, at this stage, you may have a very practical and very valid question brewing in your mind. You may be thinking, what if there is no news today about a particular company? Will the stock price stay flat and maybe not move at all? Well, the answer is both yes and no, but it really depends on the company in focus. For example, We are assuming there's absolutely no news concerning two different companies, one Reliance Industry Limited and two Sri Lakshmi Sugar Mills. So as we all know, Resilience is one of the largest company, Reliance, in the country, and regardless of whether there is news or not, market participants could like to buy or sell the company's shares, and therefore price moves constantly. Next page. The second company is relatively unknown and therefore may not attract market participants' attention as there is no news or events surrounding this company under such circumstances. The stock price may not move, or even if closes, it may be very marginal. To summarize, the price moves because of expectation of news and events, and the news or events can be directly related to the company, industry, or the economy as a whole, please. For instance, the appointment of Narendra Modi as the Indian Prime Minister was perceived as positive news, and therefore the whole stock market moved. So, in some cases, there will be no news, but still the price could move due to the demand and supply situation. So, as you notice, market participants react to news and events, and their reaction translates to price movements. This is what makes the stock markets move. So, at this stage, you may have a very practical and valid question brewing in your mind. You may be thinking, what if there is no news today about a particular company? Will the stock price stay flat and not move at all? Or well, the answer is both yes and no, and it really depends on the company focus. For example, let us assume there is absolutely no news concerning two different companies, Reliance Industries Limited and Sri Lakshmi Sugar Mills. So, as we all know, Reliance is one of the largest companies in the country, and regardless of whether there is news or not, market participants would like to buy or sell the company's shares, and therefore the price moves constantly. Next page. How does the stock get traded, I mean. You have decided to buy, for instance, 200 shares of InfoSystems at 30.30 and hold on to it for 1 year. How does it actually work? What is the exact process to buy? What happens after you buy it? Luckily, there are systems in place which are fairly well integrated with your decision to buy InfoSystem. You need to log into your trading account provided by your stockbroker and place an order to buy InfoSystem. Once you place an order ticket gets generated containing the following details. One will be details of your trading account through which you intend to buy InfoSystem shares. Therefore, your identity is revealed. Now, the price at which you intend to buy InfoSystems, see the number of shares you intend to buy. Now, before your broker transmits the order to the exchange, he needs, of course, to ensure you have sufficient money to buy these shares. And if yes, then this order ticket hits the stock exchange. Once the order hits the market, the stock exchange will through their order matching algorithm tries to find a seller who is willing to sell your 200 shares of InfoSystems at 30.30. Next page. Now the seller could be one person willing to sell the entire 200 shares at 30.30, or it could be 10 people selling 20 shares each, or it could be two people selling 1 and 199 shares respectively. Now the permutation and combination does not really matter. From your perspective, all you need is 200 shares of InfoSystems at 330.30, and you have placed an order for the same. Now, the stock exchange ensures that the shares are available to you as long as there are sellers in the market. So once the trade is executed, the shares will be electronically credited to your demat account. Likewise, the shares will be electronically debited from the seller's demat account. Next page. So what happens after you own a stock? After you buy the shares will now reside in your demat account. You are now a part owner of the company to the extent of your shareholding. And to give you a perspective, if you own 200 shares of InfoSystem, then you own about 0.0035% of InfoSystems. but by virtue of owning the shares, you are entitled to a few corporate benefits like dividends, stock splits, bonus, right issues, voting rights, etc. And we'll explore all these shareholder privileges at a later stage. Now, a note of holding period. Holding period is actually simply defined as the period during which you intend to hold the stock. You may be surprised to know that the holding period could be as short as few minutes to as long as forever. And when the legendary investor Warren Buffett was asked what his favorite holding period was, he in fact replied, forever. Now, in the earlier example quoted in this chapter, we, well, uh, we illustrated how Infosystem stocks moved from 3,000 to 3,000 in a matter of just 5 minutes. But well, this is not a bad return after all for a 5 minute holding period. If you're satisfied with each, you can very well close the trade and move on to finding another opportunity. Just to remind you, this is very possible, much possible in real markets. When things are hot, such moves are quite common. Next page. How to calculate returns and where to fit in. Now, everything in markets boils down to one thing, which is generating a reasonable rate of return. And if your trade generates a good return, all your past stock markets are forgiven. That is what really matters. Returns are usually expressed in terms of annual yield. There are different kinds of returns that you need to be aware of. The following will give you a sense of what they are and how to calculate the same. Absolute return. This is a return that your trade or investment has generated in absolute terms. It helps you answer the questions. I bought Infosystems at 30.30 and sold it 550. How much percentage return did I generate? The formula to calculate the same is ending period value divided by starting period value, which is -1 multiplied by 100. That is 3550 divided by 330 -1 multiplied by 100. Now, we are looking out for something of 0.1716 multiplied by 100, which equals to 17.716. And 17.6% is not a bad return at all, because from the look of things, it has to, as an array to the minimum reach out for most stock prices. Next page, please. Now, when we talk about compounded annual growth rate, an absolute return can be measured, misleading if you want to compare two investments, CAGR. It helps you answer this question. I bought Infosystem at 30.30 and held the stock for 2 years and sold at 3,550. At what rate did my investment grow over the last 2 years? Now we have CAGR factors in the time component, which we had ignored when we computed the absolute return. Now the formula to calculate CAGR will be ending value divided by beginning value, which is equals to 1 of minus of years -1. Now applying this to answer the question, we have 3550 divided by 330, which is greater 1 over 2 -1, which equals 8.2%. This means that the investment grew at a rate of 8.2% for 2 years, considering the fact that Indian fixed deposit market offers a return of close to 85% return with capital protection, and 8.2% return suddenly looks a bit unattractive. So always use CAGR when you want to check returns over multiple years. And you use absolute returns when your time frame is for a year or lesser. What if you have bought InfoSystems at 30.30 and sold it at 35.50? Within 6 months, in that case, you have generated 17.16% in 6 months, which translates to 34.32%, which is like for a year. Now, so the point is this: if you have to compare returns, it's best done when the return is expressed on an annualized basis. Next page. Where do you fit in? As simple as it is, each market participant has his or her own unique style to participate in the market. Their style evolves as and when they progress and witness market cycles. Their style is also defined by the kind of risk they are willing to take in the market, irrespective of what they do. They can be categorized as either a trader or an investor. A trader is a person who spots an opportunity and initiates the trade with an expectation of profitably exciting the trade at an earliest given opportunity. A trader usually has a short-term view on markets. A trader is alert and on his toes during the market hours, constantly evaluating opportunities based on risk and reward. He is unbiased towards going long or going short. We will discuss what going long or short means at a later stage. But first, we talk about the day trader who initiates and closes a position during the day. He does not carry forward his position. He is risk aversive and does not like taking overnight risk. For example, he would buy 100 shares of TCS at 22.12 at 9:15 a.m. and sell it at 22.20 at 3:20 p.m., making a profit of a bit, at least 500 rand, 800 rands. And in this trade, a trader usually trades 5 to 6 stocks, let's say, per day. Then who is the scalper trader? A type of day trader. He usually trades very large quantities of shares and holds the stock for less time with an intention to make quick but small profits. For example, he will buy 10,000 shares of TCS as 2212 at 9:15 and sell it at 22121 at 9:16. He ends up making $1,000+ profit in this trade. In a typical day, he would have placed many such trades. As you may have noticed, a scalp trader is highly risk averse. Next page. Then the swing trader holds onto his trades for slightly longer time duration. The duration can run into anywhere between few days to weeks. He's typically more open to taking risks. For example, you buy 100 shares of TCS at 22.12 on 12th June 2014 and sell it 2024 June 2014. And some of the really successful trades the world has seen are George Soros, and an investor is a rich person who buys a stock expecting a significant appreciation in the stock. He is willing to wait for his investment to evolve, while the typical holding period of investors usually runs into a few years. There are two popular types of investors. One is the growth investor. The objective here is to identify companies which are expected to grow significantly because of emerging industry and macro trends. And a classic example in the Indian context would be buying uh, Hindustan Unilever Infosystem, Gillette India back in 1990s. And these companies witnessed huge growth because of the change in the industry landscape, thereby creating a massive wealth for its shareholders. Now, the objective here is to identify good companies, irrespective of whether they are in growth phase or mature phase, but beaten down significantly due to short-term market sentiments, hereby making a great value of a buy. An example of this is recent time is L&T. Due to short-term negative sentiments, L&T was beaten down significantly around August, September of 2013, and the stock price collapsed to about 690, all the way from 1,200 at 690, given its fundamentals around August 2013. We have a company like L&T, which is perceived as cheap and therefore a great value pick. Eventually, it did pay off. as the presumed stock price scaled back to 1,440, and which was around May 2014. Yes. Next page. So some of the really famous investors in the world has been Charlie Morgan, Peter Lynch, Benjamin Graham, Thomas Roway, Warren Buffett, of course, John C. Bogle, and John Templeton, etc. So what kind of market participant would you like to be? Let's leave you with this question. Next page. We'll be expecting your answers to these questions in the DM. So you send a mail to akabog.nicholas@ztraders.com, and let's understand the kind of stock trader you would like to be. Thanks for today, and see you again next week, Friday.